Alright, sorry about that. I am back. And let's just run right through it. Alright, so I hope that this is actually broadcasting. It looks like it is. This says it is, so we're gonna just roll through this. If anyone has any questions, comments, want me to clarify something, jump right in. Alright, so what we're looking at is, of course, the U.S. economy and how that's affecting real estate. So this is just updated as of today. A lot of this information is fairly recent. The ratio of housing units to households, it's always been above 1 or 100%, meaning there's always more housing units available than households. You can see this is since 2000, and we really dropped down in the last read for the last Q2, which is the latest read that was available today. So what that means is that we're getting tighter inventory. The lower this gets to 1 or below 1 would be awful. It means just inventory is getting tighter. And that's pretty much the whole story of the presentation. So I'm using this weekly economic index as my sort of instant barometer read. We clearly had a terrible drop off. It just kept getting worse. Through April was the last negative read on the weekly prior. So this to this, this to this, this to this, everything just kept getting worse, and we stopped here April 25th. And we've slowly been climbing our way back. However, the end of July, this is the first read. These numbers get revised, I think, 3 times, and then they stop revising them. So July we only increased 5%. And you notice here, this is the first negative week we've had since April 25th. So that's certainly not a good thing. And just looking here, you can see the last recession we did, everything was humming along great. And then we had this giant drop off a cliff, came back up, and you can barely see it, but that is a tiny little tick down. And they'll tell you why. The decrease in sales offset small increases in steel and consumer confidence. I don't want to make too much out of 1 week's data, but it's not good that we broke that trend, and we broke it pretty hard. This isn't, 8% is, if it was 1%, I'd be like, well, who cares? But it's something to look at and pay attention to. Doesn't mean much of anything at the moment, but it's not good. The U6 unemployment levels, what I'm looking at. So May was 21%, and you see June here, the observation is 18%. And I use the U6 because it's just a broader measure of unemployment. I think it more accurately reflects, what's really happening out in the world. They used to use this as the number that they report. Now they report a different number, and that's what gets more, widely published in the media. And then we have some interesting data here. So our total unemployment is 31.8 million for the country. And this is all the state and federal programs combined. This Wolf Street does an excellent job of charting things. I don't see the need to reinvent the wheel when I can just use that data. And of course, I'm giving him full credit. So I'm not trying to pass it off as if it's mine. So his comments here, the POA declined to 13.18 million from 14.28 last week, as workers are pretty much getting back to work. However, and this is new from last month, There is some dispute about the PUA data integrity, and the question is, and here's the example, do claims filed reflect prior periods as states catch up with the retro claims, or are they just all chucking them into these weeks, whereas some of this is probably, from April or May, but since the states were really caught flat-footed with this whole program and it took time to set up, are the retroactive claims really being reported retroactively, or are they all just getting dumped here and then causing all sorts of data chaos? And here's the example that this AEI guy used. AEI is just a think tank, pretty conservative group. So the DOL reported last week, 723, suggests that in the week of ending July 4th, Pennsylvania had 3.4 million continuing claims, or more than 4 times the 815 continuing claims under the state's general unemployment program. Now, if that's true, that's half of the civilian population of Pennsylvania, which would be quite incredible. So I think that some of this data is skewed. I did send Wolf an email pointing out this inconsistency, and maybe that's why the monthly data, not the U6 data, I should have left it in here, it's my mistake. The unemployment data, I think, was somewhere around 10 or 12% last month. And maybe that's where this giant disconnect is, because these PUA claims aren't being processed correctly under the correct dates. All right, mortgages in forbearance. Trying to sort of just keep a running total here. We're at 7.8 as of 7/12. This is an old chart from April, I think. They haven't updated it yet, so I'm just leaving it here. But with all, full disclosure, this is somewhat dated. It's probably changed in the mix somewhat, but I don't have any more data. Maybe I should just delete it. But anyway, this is, if you just look at the chain, 83, 85, 85, 84, 84, 83, 84, 78, we're going down, which is where you want to be. I'm assuming that people are either getting back to work and thus able to start paying the mortgage again, or they're using their unemployment claims with the extra 600. I don't know, but the data looks like it's peaked for the moment. Let's hope that trend continues. All right, and then mortgage delinquencies. This is old data. They haven't updated this yet from May, so we're still stuck with Q1 data, which isn't very meaningful at this point. So I'm not going to spend a lot of time on this. Then here is Black Knight has a June mortgage overview looking at total delinquencies is 7.8 as of June. Remember, everything's old. We're all a month behind. Foreclosures, 0.36. Foreclosure starts, is up 15.69%, but year over year is still down. So we haven't really started seeing the COVID data start to get in here with some of this, just because foreclosures take so long and there's a moratorium. So none of this data really, in my humble, accurately reflects what's really happening. I think the delinquencies give you a better picture with this 7.59, or you have this number for the forbearances, 7.8. It's pretty close. All right, then mortgage rates. We bottomed out at 298 on the 16th. We tipped back up last week to 301. Still incredibly low. Still great fuel for the fire. And here's Chairman Powell just saying we're not going to raise rates. We're not even thinking about raising rates. So these rates are low and they're here to stay. You can see the recent trend is down, down, down. You can see it here as well. We just keep going down. It does muddle up and down a little bit, but the general trend is down. And at some point you would think that would level off unless we do go into negative rates, and all bets are off at that point. All right, so let's take a look at new construction and what's happening with that. New construction applications for mortgages skyrocketed 54.1% over June 2019, which is up 20% from last month, May 2020. And that was an increase of 10, almost 11% from May 2019. And you see the April figure here. So new construction is absolutely booming. This is an incredible number. Would not have guessed that that was going to happen. But this is what I love about real estate, is it's really strictly data dependent. New construction sold for the country. We were at 12.12% from June 2019. Went from 66,000 to 74,000. These are actual numbers. These are not seasonally adjusted. I'm trying to get away from seasonally adjusted data as much as I can, simply because it's really not, these adjustments are not built to handle these giant swings. So I think that's distorting some of the data and causing, again, more data chaos. And see, this is a solid run. We're 14% for May, 12% for June. Obviously, April was terrible. I don't think anyone's shocked by that. Here's the annual chart, the 1 year. You can kind of see it here, 74.66 was the June 19 read. And then you have here one family sold. This is the 5-year chart. I didn't draw the lines this time, but you can see we're still well within range. The general trend is, pretty much going up. Here's the 10-year chart. Still going up. Here's the V for April and the bounce back May and June. And then here is the longest chart that they provide from 65. Here's all your recessions. And it's important to look at the long chart so you don't just get locked into this and think, oh, it's going to go up and up and up forever. I mean, it may, but history shows otherwise. At some point, things crash and readjust. And then we have new construction stats. I'm going to zoom in a little bit so you can see it better. One family privately sold houses is green. We're humming right along. Crashed, bounced back up. Privately owned housing starts for 1-unit structures is purple. You follow the purple, going like gangbusters for housing starts. Over 1 million. These are seasonally adjusted averages. I got to use what's available. And of course it crashes and it's starting to pick back up. And then the next line is housing units completed. Again, single family is what I'm focusing on because that's the market I play in. Follow this line, it bounces, but it goes up, and then COVID comes, it drops, and we have a nice bounce back from May to June. Let's again hope that trend continues. And then building permits, same story. Goes up, comes down for COVID, starts to bounce back. And then here is the long chart, just so you can see where we've come from. You can see everything's kind of in line, and you see this whole smash from February is all condensed right here. So it's hard to read, and that's why I focused in on that. And then here is sort of the same information, again, seasonally adjusted. We were booming over 2019, outpacing. March came along, still outpaced a little bit. And then April, May, we declined. And you can see this gap is narrowing again from here and from here. Hopefully, again, this is a trend that continues so we can get back over and start building more houses than we did last year. And then prices for new construction finally starting to go back up. April, we had a big decline. May, we leveled out. And June, we're starting to be back in the green. You can see the longer trend chart. You know, there's a lot of noise. It bounces all over the place. But here's the big drop. Here is June 2019, which is also a big drop. So this drop is kind of in line with a lot of this noise. I mean, my goodness, 2018 we went from here all the way down by July. From, what is this, 342 or so down to 310. So this is not completely unprecedented, though it is pretty dramatic in 2 data points. You came from, what, 303 to 329. And then time on the market. Typically, as recessions come in, houses take longer to sell and the price goes down. So now we have the price going back up. But this time frame is increasing. We are seeing things take longer. 2019, we ranged 3 to 3.6, right? We're somewhere 3.6, and way down here in December, we were 3, and we ticked back up, still within range. And then here comes COVID, and now we're back up to 3.9, which is slightly out of range and consistent with May, which was 3.8 months. So, I mean, it's 2 data points enough to call a total trend change? No, especially if you look down here at the long chart. You know, we're still sort of in this range from, what, 2015, 2012, 2013. You know, we'll see what happens, but look at all these other recessions. It takes a while to get rolling, but you go from, what is this, 3.5, 4 months up to 10 months, where you went from, what is this, 3 or so, up to 12, 13 months. So these are big changes. They do take some time to roll through. Again, too early to say if this is 100% a trend that's going to continue going, or will July come back down within the 3 to 3.6 range from last year? Don't know. So existing housing, mortgage applications again growing like gangbusters, up 19% versus last year, 717, 2019. And that's up 2% from the previous week and 19% again from the same time a year ago. And this is a nice little stat that the Wall Street Journal provides. The big blue heavy line is the 2020. And you can see COVID is completely skewing the data. We're typically always in this, you know, you see all these squiggle, what do they call them, spaghetti lines. And we're just completely overshot. And this is, I mean, it's got to be this giant dip. It's just the pent up demand, and now it's starting to explode. But we're off the peak. Will we come back to the peak? It's entirely possible. Excuse me. So existing sales price for single family houses, we were up 7% in April, 2.5% in May, and 3.5% in June. And you can see that right here. It's unusual that existing prices go up in a recession. Excuse me, I gotta clear my throat. Pardon me. Okay, so single family transactions, and this is part of the inventory story. Just not selling as many houses, and with all the demand from these mortgage applications, it's pushing the prices up. It's more people. It's basic supply and demand. This is economics 101. So you got more people chasing fewer or the same but fewer houses. Price is how you compete, or it's at least one function of how you compete. So the transactions are dropping year over year, 17%, 26.5%, and now 11%. And this is kind of all over the place. There's no real trend here. Hopefully this keeps going up, but there's zero guarantees that that happens. Okay, so what's going on with new listings? New listings, of course, are directly related to transactions. Less listings equals less transactions. Oh, I forgot a percent here. So we were down 44% from April. People just staying home, not listing their house. Worry about it later. 30% from May, and 19.25% from June. And you can see here again, here's the 1 year. Perking back up. And here is the, what is this? This is the 5 year. And you can see it just keeps rolling and rolling and rolling. And this should have kept increasing in a normal year, just like all these other, data points. It goes up and then it rolls over as the seasons come and go, right? Fall, winter, it slows down and then it picks back up spring, summer. So that's been totally interrupted, and we're just gonna have to see what happens. And so just like new construction, we are seeing ticks up in median days on the market, 6% in April, 26% in May, and 25% for June. Again, year over year, not seasonally adjusted. These are actual numbers without any funny formulas. I mean, you just see the flow of it with the seasons, and it's kind of interrupted here. Again, we're going to see what happens. This, in theory, should pick back up. All right, and month supply, which is just a formula that they use to try to figure out how much inventory, how long would it take to burn through the existing inventory of houses if there were 0 new listings. We bottomed in February, which of course was the very beginnings of COVID talk, and we bounced back up in May. Right. And then we dropped in June. So houses are starting to move a little bit faster. We'll see what happens. And then what about good old Massachusetts? So this is the breakdown of the Massachusetts economy. Again, I know we went over this last time, but there's a lot going on here. So this is the 2019. So this is income, what people are taking home based off of the non-farm earnings, right? We're not a big farm state, so I don't even really count it. So you have non-farm earnings, and then you have all these different categories that they break it down into. And if you just take this number divided by the total, gives you the percentage. So that's all I'm trying to show, is just how important, or how much weight, however you want to say it, to each of these categories hold for the Bay State. And so this is the peak number. Now, so you put a big box here, and I changed the color because this is employees. This is not income. This is employees. And it's in the thousands. I should write that somewhere. So this is the peak from February or March. It's right on down the list. You have April, May. So you have April, you have the percent change from the peak to April. And here's the big crash. Everything fell apart. And then here's the percent change. And then again, May is the actual number of employees working. And I wish they would give us a little more detail. I mean, 0.8, is it really just 8,000 people working? It's not 8,100 or 8,152. It seems like they just rounded off to the nearest 100. which, I mean, I guess that's the best we can do, or the nearest, what, 1,000. So anyway, you have May, you have the change from the peak, which would be this number, okay? And then I also put in the change April to May, so you can see the increase, the monthly increase. And again, same story for June. This is the June from the peak. And you have the change from May to June, the sequential change. Pretty much not a lot of surprises. People are coming back to work, but we're still not doing that great. And you can pause the video here if you want to try to take a closer look at this. But at the moment, I'm just going to keep moving on. So the red states, the red categories are, the experts say these are the categories that are most susceptible to COVID-19 shutdowns and then re-shutdowns. Right, these are the first things that they're going to reclose if we have to, go back a phase instead of advancing through the phases of reopenings. I would make an argument that you could include construction in here, so I just included that as the yellow. So these reds down here are just the 4 red categories, or if you want to include construction, if you agree with me, or you just want to see what the effect is of construction, because we're somewhat in that industry. This orange down here includes all of the red and the construction. So you can see how just the net effects of all this change. And here's all the totals and the changes. And so here we are with the initial unemployment claims through the 18th, 18,638, which is nicely down from the peak, which was somewhere around 180 plus thousand people. And they don't give you a long view, but I don't really think that you need it per se, because everything was doing great all of last year. And then, of course, we fell off a cliff. And then continuous unemployment claims, we peaked at 16.8 on 6/6, and we're currently at 1501 as of 7/11. These, of course, are lagging by 1 week because these are initial claims. And to have a continuous claim, you need to file 2 consecutive claims. And I put the data here for the week ended and the rate. And these are percents, of course. So we are ticking down. Let's hope that continues through the next weeks and months. We need people to get back to work, obviously. All right, so let's take a look at new construction. Let's zoom in a little bit. New construction, we were up 25% from June, after completely falling off a cliff 40% from April, and we leveled out around May, and now we're picking back up. And so that is here. I mean, it's lumpy, not seasonally adjusted again, which adds to the lumpiness, but I like the raw data. I think it's more reliable than the seasonally adjusted stuff, which is generally okay, but with all these crazy data swings, it's not built for this. We're sort of breaking the models. But we are coming up, which is good. And then again, I like to use the long chart that they provide. Again, not seasonally adjusted. Still at 617 units. And this is actual 617. This isn't thousands. So, I mean, honestly, we're still kind of right in range here for the past couple of years. You can even that's barely a tick down. You can see it better here. 360 versus the low here was, what, 400 for February. And this low is 380, we'll call it. So, we're moving back up, which is good. People are starting to build houses again. And then we want to get into the state-specific information, and just a word of caution: the Mass Realtor versus the Warren Group data that I use. So the Mass Realtor is limited only to the MLS transactions. This is everything that you see on Zillow or Redfin or whatever service you're using. Or if you're actually looking for a house, this is what you see. Now the Warren Group gets data from all the municipalities and totals it all up, and this is everything that's sold and registered at the Registry of Deeds. So it includes everything in the MLS and all the off-market stuff, family transfers, inheritances for, the dollar just to register the name and make it official. You got to pay something for it, so it's a dollar, and that can skew some of the data, and you just sort of have to take it as a grain of salt. So the existing median price for Massachusetts, again, this is MAR. I'll let you know when we switch over to the Warren Group's data. So this is just the retail market. So prices are pushing up in spite of a pandemic, which is interesting. We were up 11.68 from April, and the 12-month, trying to smooth out all these seasonal data changes, is up 5.25. May we were up 4.5%, and the 12-month was 5.23. And June we're up 4.09%, like the formula, and the 12-month was up 5.39. And then I'll zoom in here. You can see this median price. And this chart is the 12-month is the orange line, and the actual median price is the blue line. And then down here, this is just the 12-month median price by itself. It's just steadily creeping up. And this is the exact same data, just in a different format, if that helps you envision this at all. We just keep going up. It's that simple. April was a blowout. We're back in range for March. For May and for June. Back into range. You could say it's dropping and make an argument for that, but that happens all the time. It's not a big deal. We just have this giant spike in April, which makes these look smaller, but they're really normal. Okay, and then here is the 12-month price change. So this is rolling 12-month average. And you see we had a big drop in 2019. It's still always positive. There's no negative data in this 12-month average, whereas we have a couple hits of negative data here in the month-to-month. All right, and so then closed sales is going to tell the picture of why all these price changes keep going up and up and up, because we're dropping volume substantially. So February, March were pretty normal. A 6% change month to month is fine. It's still right here. March was okay. We sold a bunch of houses, and then starting to see the bottom fall out for April. May was, of course, the worst. And June, people are starting to get a little more comfortable, I think. And that increased, 9% off of the month to month. Right? We increased 37 to 47. So it's 1,060 more houses. So that's good. We want to keep seeing this go up, up, up. But we have 3 months in a row of negative year-over-year sales. And that's what's pushing up the prices. And again, same story, same data, just a different picture. Zoom in on a minute here. So this is this tiny blip, this 0.03. It barely registers right here. And then we have down, down, down. Is that going to continue? I would assume so. I just don't think people want to list their house or deal with moving. But we'll see what the July data says in a month. And then you roll it into a 12-month rolling average. You can just look at the raw numbers. They went from 55,665 in February to a rolling 52,381 in June. And on the picture, you can see the bottom dropping out. Is this going to keep dropping? Are we going to level off? Are we going to go up? Again, it's anyone's guess. But the trend is down, which is propping prices up. Because we have more applicants. Right, we saw earlier there was more applicants and we're getting less transactions. All right, so Warren Group, this is everything. The picture is still pretty much the same. It's just slightly different numbers. 11.9 from April, 317 from May, and 256 from June. We're at 440, and where were we? Oh, I didn't put the actual dollar figure. Well, we're somewhere pushing 450 on the retail market. So that's going up. Warren Group closed sales. Again, similar story, slightly different numbers. Just due to the data that they're using. And new listings tells again part of the story. We're not getting the inventory because people do not want to move. Just staying home, staying put, putting everything on pause. I mean, some people have to move, so what are you going to do? You still got to move. So April, we lost 50% of the new listings over 2019. May, we lost 34% of the listings over 2019. And June, we're popping back up, but still losing listings over 2019. So there's less houses available. We need more houses available, and we're not getting them. I mean, granted, this trend is up, right, or less negative. However you want to put it. You see the graph, it's going up. After the spike down, it's going up. And then again, you roll it into a 12-month average. It's all down. Right, we lost 700 houses, call it, from February to June. And you see it graphically here, it just tails right off. I can zoom in here. So it's sort of all in a range, not a giant movements, and this is a big swing, especially on a 12-month rolling average. And again, we're back to Mass Realtor. And inventory is the entire story. It's just the number of homes for sale, and this is the whole story. It just keeps going down. It's getting more and more negative. And you can see it graphically right here, and you can see the trend line is solidly down, and we can't pierce above it, even though we're in the absolute strongest part of the market. Can't get above the trend line, the following trend line. And again, same information, just in a different picture. Falling, 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 falling. We need to start coming back up. And then month supply. is dropping. Again, we're below trend. 1.7 months is terrible. I mean, it's great if you're a seller, but if you're a buyer, you're getting squeezed on price on everything. And then cumulative days on market. This is the first time a house is listed for sale until it goes into its final pending status before it closes. So that's what they're measuring here. It's hard to make too much out of this data. I know the percents are here, but honestly, 83 days versus 79 days doesn't mean much. 54 days over 51 days, it's 3 days. I don't want to make too much out of it, but it is starting to perk up, which we saw in the national market. If you want to rewind the tape and go back. And then you have the blue, which is the month-to-month data here. I tried to smooth it out with a 3 months rolling average, try to get a little more seasonal, and it smooths out some of these peaks and valleys. And then this is the 12-month rolling average in the red. And that is pretty much just on a downtrend with a few perks up here and there. Here's one up, here's a slight up, kind of flat, and then dropping. And starting to maybe perk up, I don't know. I don't want to make too much of it, but this is what we're doing. And then I added some information on condos simply because we're seeing, I track this stuff. I don't usually publish it because I'm not, I don't want to make this 5 hours long. But we have 2 consecutive months of negative declines, which you'll see in the next slide is not the end of the world, but it is something to notice. We're typically up, up, up. Right, the trend line is up. We bounce around it. We get a little negative here, get a little positive here. But we have 2 consecutive months of declines, and we're going to see what happens. And you look at this is the exact same data. When you look at it like this, here's your 2 months in 2020 decline. But we've been here before. This is not anything to get overly excited about. It is a little more extreme here for June. But we've seen this before. So will it come back up in July? I don't know. It might. The trend is definitely up, despite a couple of negative reads and low positive reads. Look at this is tiny. Just gonna have to wait and see. I think the prevailing wisdom from what I've read is that people just want out of these condos. It's too close together to other people, and they're, just too congested. And it's all COVID related. You want to get out of the condos that are, I don't know, too closely packed together. And you see when you look at closed sales, really dropping off a cliff. We were up, leveled, dropped, totally fell off a cliff in May, and now we're back up. Still negative, but bouncing off the low for June. Hopefully that continues to trend up. But prices are falling. Will that attract people? I don't know. And then again, same story, same data, just a different picture, different way of looking at it. Here's this tiny negative 48 for March. And you have April negative, May giant big negative, and then June still a big negative, but looks better when you compare it to May. And we're getting close to the end here. So pending home sales. Couple things going on here. So this is USA is minus 10% for pending home sales for June. Massachusetts is totally bucking the trend. We're up 29, call it 30% over June 2019. USA, again, a big divergence for May. For the country, we're up 44.3%, but Massachusetts was down 7.5%. And, April, again, a divergence. We outpaced the decline in the United States. I think probably because we were earlier to react to the COVID and shut down faster, which does not have a good influence on people wanting to list their house. And you can see the price is up 3.4%. And if we can zoom in on this real quick, this is seasonally adjusted. Again, I like the real data, not the seasonally adjusted. Last month, last year, we would fall in the Northeast. It's a very broad category. But versus last month, we had a real bounce back. According to the index, not according to the... I mean, yeah, I guess you call it a bounce back, right? And then this is versus last year. All right, and then finally the Case-Shiller, which came out today as well. In my opinion, this is the best method of measuring prices, but it's really slow. Right? We're talking about May. And keep in mind this May figure is a 3-month average, so it's it's May, April, and March. So this is really the first, I would say, COVID number, and we're up 4.29% over May 2019, which again is May, April, March. And you can see we pretty much track the national averages. It diverges somewhat, but the general trend is pretty much the national trend, which we're just following. And again, everywhere I can, I give a long chart. We don't always track the national trend. We certainly have diverged from it in the past, and there's nothing saying that can't happen again. And that's it. That's all I got. So I think the summation is you have a real inventory story. You have a lot of demand, as shown by the mortgage applications for new construction are way up. For existing housing is also pretty substantially up. And we're just going to have to wait and see exactly what happens with the rest of it. And that concludes my presentation. Let's see what we want to do. Oh, I have the link here. Hang on. Where am I? Here's the link. What happened? Everything crapped out. All right, I guess I'm done. Save any, keep your comments going, and I can just certainly address them. Or if you want to send me an instant message or something, talk more about it. This is not really as interactive as I had hoped. Maybe I'll do a Zoom meeting next time, so we can do a lot more interaction as I'm going through this. It's kind of dry just hearing my voice drone on about all these slides. So I'm going to end the video right now. Thank you very much for watching. And add any comments, questions, hit me up. My email address is on here somewhere. castlehomesma@gmail.com if you want to have sort of a more offline discussion or something. Thanks, everyone. Stay safe out there. Wear a mask. I know it sucks. It's really hot, but it's better than a ventilator tube shoved down your throat. That's all. Goodbye.